So what truly makes a global brand really click, Especially when the market gets tough. Today, we're diving deep into your sources on the latest from Domino's Pizza. Big player, obviously. We're looking squarely at their Q2 2025 performance. Got the official press release, the earnings call transcript, all the details.
Right, and our mission today really is to cut through those numbers, get past the percentages, and understand the strategic why. How exactly are they navigating what's, frankly, a challenging environment? What moves are they making? Because it looks like they're doing more than just surviving.
Okay, good setup. Let's dive right in then. The big picture numbers for Q2. What did they actually report? Well, they announced some pretty strong results, actually. Global retail sales grew 5.6%,
Yeah.
if you exclude foreign currency impact.
Which you generally want to do for a clearer picture. Yeah.
Exactly. And then in the U.S., same-store sales saw a 3.4% lift. Internationally, 2.4% growth, again, ex-currency. Plus, they kept expanding, 178 net new stores globally, about 30 of those here in the U.S.
And those numbers, they really do paint a picture of resilience, like you said. The CEO, Russell Weiner, he put it plainly, the team delivered strong Q2 results. And they kept growing internationally despite macro challenges. That's key. It's not just growth, it's growth despite headwinds.
Suggests the underlying strategy is working, right? Not
Yeah.
just luck.
Absolutely. It points to a robust model. They seem to be able to push through even when the wider market is maybe struggling a bit, taking share.
And speaking of robust, income from operations jumped 14.8%. That's pretty significant. Does that figure jump out at you?
It absolutely does, nearly 15%. It tells you they're not just selling more, they're managing the business efficiently, controlling costs, finding productivity gains even while growing. That's kind of a Domino's hallmark, isn't it? That operational strength.
It seems to be. So, okay, how are they doing it? The CEO talked about their hungry for more strategy. Let's look at the most delicious food. Sounds simple, but they seem to have nailed it with that new Parmesan stuffed crust pizza.
Oh yeah, that launch was big news.
Huge. They called it one of the biggest new menu items in their history. Said it met high expectations, brought in new customers, and apparently the customer feedback was significantly higher than for other recent products. Big praise.
And crucially, it drove transactions, right? And boosted the average ticket because it costs a bit more.
Right. They see it as a long-term market share driver.
And strategically, this is really smart. It's not just another pizza. By making it permanent, not an LTO, they're essentially carving out new territory in the QSR pizza space. They identified, and the CEO mentioned this, a big reason why Domino's customers would go elsewhere. Stuffed crust.
So filling a gap they knew existed.
Exactly. They're bringing people back or maybe stopping them from leaving in the first place. It makes their menu more complete. It's about grabbing demand that used to go to competitors.
Stealing share with cheese, basically. Okay, but wait. If it's a higher priced item, and we know consumers are looking for value, any friction there?
That's a fair question. But its success suggests people will pay for something they really want, especially if it feels like an upgrade or fills that specific craving. It's not just price, it's the value proposition. And Domino's seems to understand they have different customer segments. Some want pure value, others will pay for premium innovation like this.
Okay, that makes sense. It's not just about the lowest price. So besides new food, they also leaned into the renowned value pillar. And the revamped Domino's Rewards program was a big part of that, apparently. A tailwind, they called it.
Yeah, especially for carryout, that's where it really shone.
Right. Carryout comps hit a record high 5.8% increase. They redesigned the loyalty program specifically to boost carryout users, and it looks like it worked. Active users are still growing.
And this ties into their whole barbell strategy for value. It's clever. On one side, you have the rewards program, the coupons driving that loyal, often carry-out customer, value-focused. On the other side, they're embracing the aggregator marketplaces. They finished the national rollout with DoorDash in Q2.
DoorDash, which is much bigger than Uber Eats and pizza sales, right?
About twice as big, yeah. So the potential there is significant. They're expecting DoorDash to really start contributing meaningfully to sales in the second half of this year. So you capture the value seeker and the convenience seeker who prefers ordering through those apps. It's broad coverage.
And delivery overall saw improvement too, right? Comps up 1.5%, both through their own channels and the aggregators. But those aggregators, they take a cut, don't they? How does Domino's make that work financially?
Yeah, that's the constant balancing act. The fees are real. But Domino's seems to view aggregators more as a customer acquisition tool, a way to reach people who might only order that way. It's about being everywhere the customer is, and you have to assume, given their scale, they negotiated pretty hard on the terms. Plus, the goal is always to eventually convert those customers to their own more profitable channels, like their app or website. It's a strategic play, not just pure margin pursuit on every single order.
Okay, so strategically sound, even with the fees. Now, let's pivot slightly to some maybe slightly more confusing financial details. We saw that strong operating income growth, 14.8%, great. But then net income actually decreased 7.7%, and EPS, earnings per share, was down 5.5%. How does that square?
Right, and this is exactly why you need to look beyond the headlines. It seems contradictory, but there's a clear explanation. The main drag on net income was a big swing, about $27.4 million unfavorable in gains and losses from their investment in DPC-Ltd.
That's their master franchisee in China, correct?
Exactly. So fluctuations in the value of that investment tied to market conditions over there hit the bottom line directly. It's not really about how many pizzas they sold in Ohio. So core pizza operations were strong, but this non-operating investment factor pulled net income down. Plus, their taxes were higher. The effective tax rate went up from 15% to over 22%. So those two things explain the dip, even while the main business hummed along.
Got it. A reminder to always read the footnotes. Okay, something more straightforwardly positive. Supply chain gross margin, up 0.5 percentage point. They credited procurement productivity. Sounds like getting better deals on cheese and pepperoni.
Essentially, yes, but it's more than just haggling. It's about efficiency, scale, managing inventory, the whole system. And the key thing the CFO mentioned is that these gains are in the base, meaning this isn't a one-time lucky break. It builds on improvements they've made over the last couple of years. It's structural. They expect to keep these gains, which is a massive advantage, especially when ingredient costs are volatile.
A sustainable edge.
Okay.
But then another little wrinkle. U.S. company-owned store gross margin actually went down by 2 percentage points. They cited higher insurance costs, higher food costs passed to stores. Though sales leverage helped a bit.
Yeah.
But you have to stress, this is a small number of stores, right? Not really reflective of the franchisees.
That is such an important point to make. Absolutely critical. The corporate stores are a tiny sample. The real engine of Domino's is the franchise system. They always talk about best-in-class franchise economics. The average franchise has, 9 stores? They're generating serious cash flow. And look at the recent refranchising deal. 36 corporate stores in Maryland sold to a very experienced franchisee, someone who's been in the system over 20 years.
So they're putting stores in the hands of proven operators.
Exactly. It strengthens the system, leverages that local expertise, and because their franchise base is so diverse, there isn't really a concentration risk like you see in some other systems. It's a healthy model.
And their confidence shows in how they're using their cash. They bought back $150 million worth their own stock in Q2, still have over $600 million authorized for more buybacks. Plus, they declared a quarterly dividend of $1.74 per share.
And they can do that because their free cash flow is so strong. It was up nearly 44% over the first half of the fiscal year, reached over $330 million. That strong cash generation funds the buybacks, funds the dividends. It shows the core business is throwing off a lot of cash, and management is committed to returning a chunk of that to shareholders. It signals confidence.
Okay, so strong performance, some financial nuances, but overall confidence. What about looking ahead, the outlook? They reaffirmed their 2025 guidance. Global retail sales growth pretty much in line with last year. And for the U.S., they expect same-store sales growth of 3% for the full year, with the second half being stronger than the first.
And that outlook is really interesting when you put it against the backdrop of the wider QSR pizza market. That market's been basically roughly flat so far this year, facing headwinds, consumers hunting for value. But Domino's kind of flips that. They see the value focus as a tailwind for them. Why? Because, as they put it, they are built for this.
Meaning their model is inherently value-oriented.
Exactly. Value, delivery, efficiency. They have strong franchise economics, that super efficient supply chain, a big ad budget. It means they can effectively play on offense, launch new products, market heavily, while competitors might be forced onto defense just trying to protect what they have. It's a position of strength.
And that confidence extends to their product strategy, too.
Uh-huh.
The CEO stressed that things like the New York-style pizza and now the stuffed crust. These are permanent additions, not just flash in the pan LTOs. They're building a permanently stronger, broader menu to keep driving share year after year.
That permanence is key. It changes the baseline.
Definitely. And they're innovating elsewhere too.
Hmm.
Cautiously rolling out a new e-commerce platform, which is critical since, 85% of their orders are digital?
Huge number. So that platform has to be flawless, enhance the experience, make ordering even easier, and then longer term, this idea of potentially adding a second cooking platform, like fryers.
Imagine Domino's fries.
Right. It sounds radical, but they mention that store layouts are getting more efficient, creating space. It shows they're thinking way beyond just optimizing pizza, potentially new menu categories, new day parts. It's long-term thinking about growth.
So the big picture, the long-term vision is clear then.
I think so. It's continued market share gains in pizza, leveraging everything in their arsenal, as they say. Franchise strengths, supply chain, product innovation like stuffed crust, digital platforms, the aggregator partnerships, it all works together. The goal is straightforward. Deliver best-in-class results, keep winning for shareholders and franchisees.
So wrapping this up, what does this deep dive mean for you, our listeners? I think it shows that strong performance, especially in tough times, isn't just about flashy numbers. It's about the strategy underneath, the smart product moves, the operational grit, the financial discipline. That's what powers a giant like Domino's. It's that combination that lets them win share when the market's flat.
Yeah, and it really poses a fascinating question, doesn't it? In a world obsessed with value and convenience, how does a company like this keep innovating and grabbing share when things get tight? Their mixed permanent new products, strong loyalty, strategic partnerships like DoorDash. It's a really compelling case study. It goes beyond just pizza, I think. It's a masterclass in adaptation.
Makes you think, doesn't it? A golden year isn't just luck. It's often built on years of strategy, really knowing your customer and having the guts to make those big permanent changes. You have to wonder, what other industries could learn from these hungry for more ideas? Where else could this blend of innovation and strategic value really shake things up? Something to ponder.